All right, so John, let's start off. What's your word of the day? How do you see today shaping up?
Resilience is what we're looking for. And in that sense, we're looking for resilience when we look at the jobs numbers. We're looking for resilience within the equity space. And we think based on what we've seen this week thus far, with only not even a haircut, but just a little trim yesterday overall, this looks very positive.
All right, looks very positive. What are you expecting from this jobs report? The estimate's 214,000. Are you expecting, the actual number to meet that estimate? And also, is this still really a market mover? I mean, we just heard from Jay Powell this week at the Deal Book Summit. We're going to hear from some Fed officials today. The cut in December pretty much seems like it's going to happen. Is this still potentially something that could move markets?
Yeah, we have very much expected that we're going to get a cut in December. We think that the Fed is very much saying that it is in the process of trimming its benchmark rate. At the same time, I think today, in the immediacy of it, when the number comes out, if it's disappointing or if it's hotter than expected, we could see a little rumble in the market, but we're not looking for anything that would be substantially market moving. We think essentially what you're looking at is that resilience, economy, no recession, moving towards sustainable economic growth at a pace that doesn't have a lot of inflation in it. Okay. And allows for very low unemployment.
Can we talk about valuations for a minute, John? I'm looking at the S&P trading at about 23 times forward earnings. The NASDAQ even higher. The small caps even higher than that, above 30 times forward earnings. How big of a concern is that in this market if this rate cut path is disrupted, whether it be by inflation or changes in the job market?
Well, if the rate path were disrupted by something dramatic in terms of a much higher level of stickiness in inflation, I think without a doubt the market would get jostled somewhat from that. But we actually think that where we are, essentially what we're seeing is the Fed has done the job. It's been remarkably sensitive, this Fed funds hike cycle, at avoiding a recession, and very much watching its dual mandate, essentially having a good economy without untoward levels of inflation and a low unemployment rate, or what is called full employment, in essence, unemployment running at around 3 to 4%. So okay. We think that near term, there's always the potential for some volatility in the immediacy of it all, a number that could jostle somewhat. But we do think that the overall call is supported by fundamentals here, and also by investors who are investing for need, intermediate to longer term, who can sustain some volatility in the market if they see it. And then actually, if we get some volatility, opportunity to look for babies that get tossed out with the bathwater.
All right. John, what is your pick for us today and why?
For today is consumer discretionary. We continue to like it. As I recall, it was the best performing sector yesterday. It's been a sector that has been very much disappointing for a lot of this year, and then suddenly is getting quite a bit of play. We've been big believers in it. We always say don't bet against the U.S. consumer. When they feel flush, they spend like sailors who've been on a long term of duty, you suddenly have shore leave. When times are tougher, they buy private label, they buy at discount, but they keep shopping. And we think the economic balance sheet of the consumer remains remarkably good, considering how long we've been in a Fed funds hike cycle since March of 22 until just recently in September, and most recently in November, where we saw the beginning of the rate cuts.